Hello and welcome to today's FatTel Daily video. Glad you're joining us again at the end of the week. I'm joined today by Charlie Ormond, who is our tech analyst here at FatTel Investment Research. Charlie, welcome.
G'day. Thanks for having me.
Yeah, good. So we had a nice little guest appearance from yourself this week, and today you are talking about potentially the life cycle of big tech companies and how they go from startup phase to a big monolithic giant that basically they lose sight of what their core business model or mission was. But you kind of you explain this in a phrase which I've never heard of, and you brought it to my attention this week. It's called "end-shitification."
Yeah,
So
it's a bit of a
first of all,
tongue-in-cheek.
yeah.
It's quite a funny
Before we
one.
go into the topic of your piece today, then can you just explain what you mean by that term?
Yeah, so it was coined by Cory Doctorow. It's a bit of a tongue-in-cheek play, but the basic idea of it is that essentially most of these big tech firms work on the idea of scale. So they want to get as many users as they can in the door at the start. So they're extremely great, they have great user interfaces. They're dirt cheap most of the time. If we think about Amazon when it founded, cost was coming in at the cheapest things you could find. Often they'd free ship things to you. Similar with Facebook, you know, privacy focused, only your friends and family, really great user interface. And then as they get larger, they then start scaling away from the user and towards the business practices. So the business partners become favored. They start selling your data in the Facebook example, or Amazon starts, bringing up its costs in other ways, so it charges you more. And then eventually you get to the third phase, which is what I'm arguing we're in now. So it's the third phase of enshittification. It's quite a funny term, that one. Where essentially they're hurting both users and their business partners. So the
Right.
best example of that is Amazon, where it's really like third-party sellers are now getting their margins squeezed to now single-digit percentages. And even now, we've seen some many cases where Amazon is actually looking at successful businesses. Diapers.com is a great one, and they steal their business plan because they see how successful they are on their platform, and they sell it themselves.
Mm.
So that's the final phase that I think we're in now.
Yeah, I remember when take Uber for example, when that first
Mm.
came to Melbourne. I remember being able to get a lift from the city to back where I lived for I don't know $8 or something. Good luck doing that today from the.
Exactly. I had a great conversation. Like I constantly, you always have those little chats with Uber drivers, but I
Yeah,
was chatting with one the other day. He was saying he earns a quarter of what he did 2 years ago,
yeah.
So that they're really hurting both sides of the business now. And it's kind of no coincidence that to an end of 2023 was the first time that Uber posted a profit in its entire decade existence. So that's where I'm arguing this kind of end phase and shitification means that
Yeah.
they're really hurting everyone to get that maximum profit.
So how do you see this trend evolving from here? Like what potential disruptors or new business models might emerge to challenge this the current phase of enshittification in the tech giants?
I think there's two different points I'll bring up. First one
Yeah,
is
yeah.
not so much in the competitive phase, it's more in the political sphere. So there's always natural cycles of antitrust versus low competition. And so the classic example is kind of the 1890s, where you saw all of these major manufacturers shrink into a handful in America due to the fact that everyone was getting their first steam engines or the first major machines in the factories. So the ones that could afford it ate up all the small ones. And that created the Sherman Act, which is the famous antitrust case that kind of changed that cycle. So I think we're in a similar cycle now where we've seen 2 decades of extremely low competition, where the people like Facebook and Google and Amazon can just buy up any of their competition. Most of the time, we don't even hear about it. But
Mhm.
there was an interesting little tidbit fact in the article there where it was something like near 700 companies were bought for around $1 million in the last decade or so. So that they're just simply quietly buying up all the competition in the background. And so I think that there is a definite step change we're seeing in the political realm for antitrust and anti-competitive behaviors starting to be squashed down. So I think with that, you get a natural bed of competitors that will come into the space. If we look in the AI example, where everyone thought OpenAI was going to be the latest and greatest, there are now thousands of smaller ones that are bringing in models which are of equal strength. So I think
Yeah.
it's going to be this new age of competition, and I think it's a really exciting time if you're a young stock picker to find those.
Totally, yeah. And we'll come back to the stock picks. But just want to just hang on the antitrust lawsuits. Like so, they're becoming more common, and that's what you say in your piece. But how do you
Yeah.
think increased regulatory scrutiny might reshape the tech industry or impact investors' strategies in the coming years? And I know that might lead on to the stock picks, but we can come
Yeah.
to those.
So the thing that I'm not just kind of pulling this idea out of nowhere.
Yeah.
The current FTC commissioner, Lena Khan, she's the youngest woman that's ever been put into this role. She's 35, an absolute gun. She wrote her paper on Amazon and how to break up Amazon, and she was put into the place, and it's one of the few places within America's massive dysfunctional political realm where it's actually bipartisan support. So she is kind of this bulwark of this anti-competitive um, behavior being snuffed out. And so that means that these folks like Amazon or Facebook or Google now won't be able to necessarily buy up those competitors that they could before. Think of like WhatsApp and Instagram as good examples that were massively outcompeting Facebook's growth, and then Facebook just bought them. So I think we will see those new kind of companies come in. A good example in this space is Perplexity, we were mentioning a few times around the office as a
Well, we
really
use
good
that
competitor.
in-house for research purposes, don't we?
Absolutely. It's a great competitor versus Google. So I think companies like that are no longer under the threat if they get a little bit too big to just be bought out by Google anymore. Antitrust will stop that. So it's about competition coming in, and that will mean that the services will actually having to start offer better services in terms of like the Googles and Amazons. So their margins will compress, right? So then they might not be as profitable, or their stocks might not do as well, and competitors might come in. So it's a massive disruption to that big tech, and it really just means that the field is a little bit more open for other competitors to
What
come
if
in.
they want to be bought out, though?
Yeah, if they want to be bought out, I can understand that being an individual concern, but the idea of antitrust is to make sure that it doesn't hurt the consumer.
Yeah.
All right. And I think that that's having an even playing field is kind of the cornerstone of an effective market. So I
Mm.
think that even if they want to be bought out, it can't hurt the consumer in the long term. So
Yeah.
that's really a factor to think of there.
Yeah, yeah. So another thing you highlight in your piece is the recent underperformance of big tech stocks despite meeting earnings targets. So I was going to ask, what key factors do you believe are driving that? And do you see it as a temporary correction or a signs of a deeper, longer term trend?
Yeah, I mean, it's a hard one to say if it's a deeper trend or not. It's certainly, I mean, 2023 till now has been a fantastic run for big tech, right? Silicon Valley's done extremely well in that time. But even the last second quarter numbers weren't that bad. You know, I think it was 80% of companies had a positive earnings per share surprise. So that's above what they had already guided. But guidances are kind of baked in with a lot of tech. They usually kind of will undersell their growth and then have that big surprise. What people actually look more towards is the guidance for the future. And there we're noticing a couple of turbulence in the market. We've seen about 67 companies in the S&P 500 so far say they expect negative guidance for the future. And noticeably, I was actually looking at this today, 30 mentions of potential recession within earnings calls. So there is definite signs there where it's not necessarily that there's trouble now, the earnings were okay by and large, but it's certainly concerns of the future. And some of those things can be to do with the macro concerns we've seen around oil prices, right? Around concerns about the Fed cutting rates too late, the shift we've had from bad news in the economy, meaning that the stock market does well because people go, oh, the Fed will cut rates because things are looking weaker. That's kind of stopped now. So it's now really up to the companies themselves to make sure that their own houses are in order to move forward.
Mm. Um, we kind of thumbnailed this video. The golden age for big tech or Silicon Valley's over, but it's almost like what you're saying is it's more that it's a rather than the end of tech because you're a tech analyst, right? I mean, you're very very forward looking, but are you sort of saying it's rather than it's the end of a big tech golden age, but maybe the dawn of a small tech golden age?
Yeah, I would say it's a regression to the mean if you're going to use
Yeah.
a technical term for it. They've been this incredible run, like absolutely outstanding run. And now I think it's going to kind of come in line with the rest of the market.
Mm.
So I think it's less about it being like, oh, it's over, it's going to crash to zero. Some of the big names might see themselves fall back into some more kind of reasonable valuations, we would call it. But I think it's more about the idea of the golden age of absolute growth beyond anything
Yeah.
might take a breather,
Yeah. Yeah.
you know?
So,
So that's where I'm at.
let's finish on the investment implications. So, given your recommendation, part of the recommendation you say in the piece is that it might be time for investors to take a more active approach and focus on the smaller, undervalued stocks, rather than just passively putting your money in, ETFs or whatever, which is primarily made up of the bigger companies, and they could be going backwards if what you're saying comes to light. But what specific sectors or types of companies then do you think offer the most promising opportunities with all this in mind?
Yeah, that's a good question.
Bit
I
of a
guess
long-winded one there. Sorry.
no, it's a good question, and it's kind of cuts right through to what you need with that. I mean, first I'll look at what the passives are doing, and then so how you can be away from that. Essentially, that's the easiest way.
Hmm.
So, we have about $25 trillion worth of passive funds sloshing around. Most of that sitting in these major funds like the S&P 500. But the problem with the S&P 500 is 30% of that is just the Mag 7
Yeah.
stocks.
Yeah.
That's those big tech names. So the idea that you could kind of coast along with that and follow those big gains has been something that's been true in the past, but I'm arguing won't necessarily be true in the future. So if you want to find positions of things that will be away from that, you obviously need to get away from those big tech names to begin with. So if you've got positions in the big tech, I argue it's a great time to do some profit taking and then to move into things that I think are undervalued, right? So we've seen utility stocks as a great undervalued play at the moment. That also kind of works in tandem with the future. If you think of the idea of energy concerns with use of AI, or just in general, we've seen a lot of issues with energy concerns. I think utility stocks are a great one at the moment. Broadly, other energy sectors would be quite good. Looking at actual real commodities and real assets would be quite helpful in this time, because when things are looking shaky, people always return to real things. Just look at the price of gold right now, absolute all-time highs. There is a reason for that, right? So returning to those kind of bear principles is a really good thing, but also moving into smaller caps. So that's things like if you just go into the Russell 2000, which is the small cap index in America, hunting around for the outperformers in that is a really good thing to look at in these times. If we think of, the GFC in '08, in that 2000s era, most of the small caps outperform the large caps in the longer run. So it's really about being active, looking for those small outperformers, spreading and diversifying that risk, and not following those big names. Because even if you think you're away from them, if you're in a passive fund, you're along for the ride.
Yeah, gotcha. Final question, Charlie. What's the most exciting tech sector in your view that you're watching for the next 5 years?
Most exciting tech sector for me, I think, has to be biogenomics. So that's the integration of AI into genetics and biology. The genetic code is such a long and complicated thing, and it has so many little foibles that we're yet to understand. Being able to use AI to understand that can unlock so much for us. If the future we can build proteins and cure diseases and even just make ourselves faster, better, stronger, it has a lot of amazing implications for the future. So I'm really excited about that sector.
Right, that sounds like a topic for the future too. We'll dig into that one because that's a fascinating topic personally for me as well. Thanks for your time, Charlie. Much appreciated. Look, guys, if you've enjoyed this video, this little discussion, give us a comment below. Subscribe to the YouTube channel, of course, and you can read Charlie's piece that we based this discussion on for free. Just in the comments below, you can head direct to the article on our Fat Tail Daily website. You'll also find a sign-up box if you like what you've seen today and you'd like a free daily insight every single day direct to your inbox. So thank you, Charlie. Much appreciated.
Thanks, mate.
Have a good weekend, everybody, and we'll see you next week. Cheers.